If you're a macro trader, let me save you a lot of time. In this video, I'm going to give you a filter. It's just one simple rule that filters out 80% of the dumb trades you take on news. See, we have a problem in this industry. It's the more is better fallacy. We think that because we have 6 monitors and access to all the data in the world at any time, we need to have an opinion on everything. You have a finite amount of decision-making energy every day. It's like a battery. Every time you analyze a setup, you stare at a minute chart during a news release, you drain the battery. And if you spend 80% of your energy fighting during a news release that does not matter, that is noise, then what happens when the real move actually happens? You miss it. So how do we fix this? How do we know what data point really matters so that we can focus on that? You need to align yourself with the only players in these games who actually matter. The central banks, the Federal Reserve, the European Central Bank, Bank of England. And if it matters for the central bank, it matters for markets. So before you take a trade, any trade on a news event, I don't care if it's a red folder, I don't care if it's an orange folder, you simply ask this one specific question. Does this number change the picture for the central bank? Let me explain why this works. Central banks have a mandate, right? Usually it's 2 things: inflation and labor market. They have a massive ship to steer. They don't just turn that ship because one single low-tier data point just missed expectations by a tiny margin. They steer the ship when the whole objective changes, okay? So when a number drops, you look at it and you ask, does this change anything for Powell or Lagarde, whoever you're looking at? Does this change his mind? Does it give him reason to cut, to hike, to not do anything? Does it move the needle for the central bank? 8 times out of 10, the answer is no. Simply no. Let's say the ISM services PMI comes in about almost 1 point above expectations. Does this number change the context, the entire monetary policy decision making of the Federal Reserve? It does not. Let's say a consumer confidence drops a few points lower in Europe. Does the European Central Bank suddenly panics and cuts rates on this number on the very next meeting because of this? No, it does not. See, there's going to be a lot of these no's, and simply, if the answer is no, if it does not move the needle for the central bank, what do? You do nothing. You sit on your hands. And here's where it gets even trickier. The chart will move anyway. There can be volatility on news events, even if they don't change anything. That does not change the fact that the news did not matter. Listen to me very closely here, because this is the most important part. Don't let the market reaction dictate your decisions. If the market reacts on a news event, it doesn't necessarily mean that the news event was actually meaningful. It doesn't mean that this is going to have to continue moving in that direction. We have to analyze, does this number actually move the needle for the central bank? If it does, we can trade in that direction. If it does not, we do nothing. So if the fundamental story has not changed with this number, this move is something that we do not want to chase. We do not even want to trade. It's going to do whatever it wants to do. If you learn to let that move go, you'll save yourself from 80% of the stop losses you take on news, because it is just chop. It's that irrelevant and non-significant move that gets you on the wrong side of the market. But then there are 2 times out of 10 where the answer is yes. The 20% of news that actually drives 80% of the moves. There are moments where the data is so relevant, so off of projections, that the central bank pays attention to. Imagine CPI suddenly drops from 3% to 2.6%. Does the Fed care about this drop? Yes, they do. Does this change the narrative from inflation risk to disinflation? Yes, it does. This is a quality trade that we want to take advantage of, because it triggers a repricing of the entire context, the entire market expectations of what the central bank will do next. So this is when we execute. Now let me show you practically how this looks on a chart. Look at this spike on USD. This was a retail sale miss in the US. Now, this reaction would fool anyone that only focuses on the chart. Because if you look at the chart, it looks like a big deal. But now ask the question, does this 0.2% miss in retail sales change anything for the central bank. If they are 100% focused on upside risks to inflation in that moment of time, will it prompt them to cut rates just because of a 0.2 miss in retail sales? No. So what happened here? Absolutely nothing. Price chopped despite the initial reaction. Do not let the immediate reaction dictate the way you look at the data, the way you interpret the data. Because sometimes it's just an overreaction, sometimes it's algo, sometimes it's just a move. We don't have to always explain that move, it just happens. What we have to do is understand whether the number that we're looking on a screen, on the calendar, whatever you look at, actually changes something or not. So in this case, a 0.2% miss in retail sales doesn't change absolutely anything. And so this is what I want you to not get stuck into, okay? News trading is not about trading every single piece of news. It's about trading the news that move the needle for the central bank. A 0.2 miss in retail sales is just not too relevant for the central bank. And look, I'm not saying retail sales in general are not relevant. The point I'm making here is that the data is relevant when the central bank says it's relevant. If the Federal Reserve here, before this retail sales number, at the previous meeting, let's say hypothetically they said that they were highly attentive to any downside miss in retail sales data, then well, yes, absolutely. This 0.2% miss in retail sales was going to be a lot more important if they did say that. But they didn't. They were 100% focused on inflation, CPI, PPI, PCE, whatever. Understand where I'm going here? If it matters for the central bank, it matters for markets. That's when you can trade a news event and economic data. Because look at this. Same context, Fed 100% focused on upside risks to inflation. Suddenly, the CPI comes way cooler than expected, turning around the whole balance of risks. Now, the Fed was worried that inflation was picking up from 2.9% to 3.1%, but it actually stays to 2.9%. So it's not picking up, it's defying expectations here importantly. So does this change the big picture for the Federal Reserve? It absolutely does. This is going to allow them to be less hawkish or way more dovish, since upside risks to inflation are not materializing the way they thought. And so look at this move. It continued after the data. Now, if you're still watching the video here, it means you're either an experienced trader who knows what I'm talking about, or you're a beginner who is realizing just now that your new strategy that you learned, whatever you learned, is actually just gambling. Either way, if you like what we're doing here, do me a favor, hit the like button below so the algorithm knows that intelligent macro is the thing actually people want to see.